Hello, everybody, and welcome back to SEC Roundup. My name is Nick Morgan. I'm with Paul Hastings, and I'm pleased to be joined today by three of my partners at Paul Hastings, all of us in the Investigations and White Collar Defense Group, Morgan Miller in DC, Ken Herzinger in San Francisco, and Tom Zaccaro, of course, in Los Angeles with me. Hello, gentlemen.
Hi, how are you today?
Hi there.
So the reason we're all getting together, all of us are former SEC enforcement lawyers, now defending folks in SEC matters, and among other things. And of course, the SEC just put out its annual enforcement report. And so we wanted to talk about a few of the things that the SEC was up to last year in the hopes that we can help sort of figure out where they're going in the coming year so that our clients can be prepared. So let's start out just by talking sort of big picture. The SEC was very proud to announce that it had a 9% increase in terms of the number of enforcement matters it brought last year. So it was 760 total enforcement matters. I will point out, because we got together and did this last year, that this is a 9% increase over last year, which was a significant drop from the year before. So maybe with this increase, they're back up to where they were 2 years ago. That 9% included 462 standalone cases and 129 actions involving delinquent filers and 169 follow-on administrative proceedings, the follow-on being following some other proceeding, usually in federal court. The SEC also touted the amount of money it brought in, a total of $6.4 billion, combined civil penalties, disgorgement, and prejudgment interest. That was a high mark on the penalties, with 4.194 billion brought in for civil penalties, which was the highest on record. Disgorgement amount decreased from the prior year. It was at $2.24 billion. That was a 6% decrease from last year in disgorgement. So clearly weighted towards more penalties in the previous year. But those are the numbers. I think they're kind of interesting, but I think more interesting is the specific subject matters and types of cases they brought. And Ken, let's start with you, because I think one of the topics that obviously has taken up a lot of the SEC's time in the last 5 years, really, is their focus on digital assets and cryptocurrencies. Can you talk about some of the enforcement matters in that area that were brought last year?
Yeah, so the two matters that the staff flagged in their press release are two first-of-a-kind matters. So the first one, the staff brought an action against a crypto entity in connection with crypto lending. So this was the first of its kind, where the staff alleged that a crypto lending product was a security. And what's interesting about this case is that the staff charged and settled both under Howey and Reeves, arguing that the product was a security under the Howey test and the Reeves test. What's particularly interesting about the settlement, though, is that the staff didn't provide any legal analysis under really either of the tests. And the sole case that they cited for Reeves, which is SEC v. RG Reynolds, actually doesn't support the proposition for which they cited it. So, as always, it's a first of a kind case. It's particularly noteworthy. Certainly, people in the industry should be aware of it and cognizant, but, no court has yet to hold that a crypto lending product is actually a security. So that was an interesting first of its kind. The other one, which got a lot more headlines, was the staff brought its first crypto insider trading case. And what I thought was particularly interesting about this case is that they alleged that at least 25 crypto assets were traded improperly based on material inside information, but they said only 9 of which were securities. And then they went ahead and, listed those assets and, described why they were securities. When you parse through, the various different allegations, it looks like the staff may have tried to line up, assets, not only that they thought they could show were securities under Howey, but more importantly, they had to prove an insider trading case. So they had to find ones where the value actually popped after they were listed. That was the whole allegation of the material inside information, that the individual knew they were going to be listed and traded in them, and then they popped and benefited. But I thought that was interesting. And the other noteworthy thing is, unlike all the other cases where the SEC has alleged numerous assets are securities like the exchange cases, they did actually list them this time, which is good, since the market really doesn't know what they're signaling when they settle these cases if they don't even list the underlying asset. So that's the crypto beat.
You know, Ken, it was interesting that that insider trading case also brought up the sort of turf wars between the regulators, if you recall. DFTC commissioners following the filing of that case said, "Well, wait a minute,
Yeah,
you may have gone too far here." So
yeah.
but it also highlights the continuing interest by the SEC in the topic of insider trading generally, and the continuing effort to take traditional insider trading cases and expand them out. And so, Tom, can you maybe talk about some of the insider trading cases that they brought this year or that were litigated this year?
Sure. Insider trading continues to be a staple of the enforcement division. This year they brought, I believe, 43 cases, about 6% of the total cases. So the insider trading cases are steady part of the enforcement program. Ken highlighted the crypto insider trading case, which reflects the staff's moving out of the traditional concept of insider trading to other areas, the crypto, for example. And then in last fiscal year, we saw the shadow insider trading theory for the first time, in which someone was charged, an employee of company A had information about company B, and as a result of that information, he reached some conclusions about how it might affect other similarly situated companies in the industry and invested in one of those companies. And sure enough, when company A and company B announced their news, company C's stock went up. He had purchased company C's stock, and as a result, the SEC charged him in insider trading. That's still in litigation. Many have challenged or have questioned the SEC's theory. And we'll see how that plays out. Hopefully there'll be a resolution in this fiscal year. But I think the biggest news in insider trading in the last fiscal year was not made by the Division of Enforcement, but rather the Commission itself. And that is in its proposed rule, proposed in December of last year, of changing Rule 10b-5-1. Rule 10b-5-1 allows corporate executives to draft plans to sell their company's stock, regardless of whether they have inside information or not at the time of the sale, so long as they enter into the plan without having any MNPI, and then the stock is sold pursuant to the plan without any discretion by the executive. It's a defense to an insider trading charge. The Commission has long believed that there have been abuses by corporate executives in manipulating these 10b-5-1 plans in order for those executives to sell shares at advantageous times. So the proposed rule suggests things like a 120-day cooling off period between when the plan's adopted and when the first sale can be made pursuant to it. Executive officers need to certify that they had no inside information at the time they entered into the plan. Executives cannot have overlapping plans. So some executives in the past have had multiple plans, which the Commission felt was a way by which those executives manipulated Rule 10b-5-1. Companies have to make more disclosures of the existence of plans, and are required to disclose, or would be required to disclose, any grants of shares made to corporate executives within 14 days of the release of material non-public information. So it's a sea change in how Rule 10b-5-1 works now. As I said, the rule has just been proposed. There's been a lot of comment on it. There's been no final rule yet. And of course, the entire industry is waiting anxiously for that to drop. It's interesting that the only insider trading case that the staff highlighted in its press release was a case they brought in September against two corporate executives for trading pursuant to Rule 10b5-1 plan. It's an insider trading case, and the commission alleges that the executives had material non-public information, not when the shares are sold, but when they originally entered into the plan. And that, of course, would negate the defense for insider trading. So I expect in this fiscal year, we're going to see some resolution to the rule on 10b5-1. And I think we'll see more unique and out-of-the-box applications of the insider trading theory.
Indeed. Well, thanks, Tom. And another area of perennial activity by the SEC is in the Foreign Corrupt Practices Act space. And Morgan, maybe you could tell us a little bit about that and other areas you might see in cross-border enforcement activity.
Sure, happy to. And look, I think over the last fiscal year, the number of settlements has remained relatively low compared to some of the historic years, both in terms of the number of settlements and even the amounts that have been subject to penalty and disgorgement. There were six settled cases last fiscal year, which is below what has been generally around 10 or so on average, going back to like 2013. So we know there are a lot of investigations that are ongoing, some that have been successfully resolved without an enforcement action. But I think the 6 actions that have been brought have been fairly similar to the same types of actions we've seen historically. There were, I think, 3 of them involving conduct in Latin America, 1 in Africa, 1 in the Middle East, 1 in Asia. So geographically spread. I don't think any of the 6 companies were in the same industry, from airlines, telecommunications, technology, waste services. I mean, sort of the gamut of industries, geographies. I think if we were to look at some of the conduct, some of them dealt with different types of slush funds, and a lot of that driven by internal control considerations. One in particular, the Goal Airlines case, which was among many of the resolutions that really focused on the company's internal controls, and comments by the staff that as companies are looking at internal controls, whether it's from a geography with really high growth, rapid growth in that market, but not to focus on just one element of the internal control structure. That case had allegations of conduct at the top of the organization, and a lot of the focus by the staff was really around whether those internal controls are reaching that level, whether the executives are really playing by the same controls and subject to the same controls as the rest of the organization. And I think that was one of the messages we heard, directly from the head of the SEC's FCPA unit. And there have been other themes we've seen on the internal control side, whether it's recommendations and a focus on the use of compliance consultants, the role. I know we're going to talk about some of the messaging areas, but when it comes to personal devices, the role of compliance, how that is really fitting into the fabric of the company's internal controls and how they're maintaining and managing communications, because it's not relevant. Obviously, it's relevant to an investigation and the ability to obtain that data if under subpoena or in connection with an investigation. But really, how are you able to maintain day-to-day compliance if you don't have access and visibility to the key communications within the organization on a day-by-day basis? So looking at it not just when that big issue occurs, but how is that compliance program managing those risks, day in and day out. So I think those are certainly some of the areas. Recidivism popped up, which again is really not anything new. So again, I think one case really had a fairly significant amount across the US, UK, and other jurisdictions. The others were not particularly notable by the amount of disgorgement or penalty. The only other thing I'll mention, which is not SEC related, but certainly something that has been a big development, and I think will play out in the coming months, is a recent agreement that was reached between the PCAOB and the China Securities Regulatory Commission and the Ministry of Finance in China, where they really now have a statement of protocol, which is something that is part of the obligation that the PCAOB has under the Holding Foreign Companies Accountable Act from 2020, and their ability to really get in and have access to audit work papers, personnel, other information, so that they can fulfill their duty to investigate audit firms and others that are ultimately working with companies on the US market. So how that's going to play out certainly is to be determined, but that agreement itself, I think, is a big step forward.
And I'll just wrap up. I think we'd be remiss if we're talking about the enforcement division without talking about the pending Supreme Court case, SEC v. Michelle Cochran, which the Supreme Court has already heard a oral argument on. The issue is whether respondents in administrative proceedings have access to federal courts when questioning the constitutionality of the administrative proceeding itself. So if the court rules in favor of Michelle Cochran in that case, it's possible we'll see more federal court challenges to administrative proceedings. So that's another one to keep your eye on. Gentlemen, I think we're out of time. Thank you all for doing this. And to everyone else, we'll see you on the next SEC Roundup. Thanks and goodbye.
Thank you.